Thank you very much, Kai, for putting together such a great conference. I really enjoy being here, and I look forward to talk about Koyaanisqatsi. Has anyone here seen this movie? It's from the 1980s. Yes, there's one gentleman. Well, Koyaanisqatsi is not a new tool by the Federal Reserve or a new COVID variant or a new rap star from Sierra Leone. It is actually a movie about life being out of balance. And I thought when I watched this movie, it's actually quite an apt analogy for markets, financial markets, capital markets, political life, and many other spheres of our life being out of balance. But just quickly, I want to shout out a big thank you to our premium partners. Without them, it wouldn't be possible to put out such a big report. Every year, we are 20 people working on this report. As Kai said, we had roughly 2 million downloads. We are publishing 15 publications now with all the chart books. We're doing special reports. And it wouldn't be possible to make this available totally free of charge in German, in English, in Mandarin, and starting this year also in Spanish without the support of our premium partners. So thank you very much. Now, Koyaanisqatsi, let's talk about that briefly. The Hopis, it's a native tribe in America. They say before you take any decision, consider its effect on the next 7 generations. Well, that's actually quite a different perspective and quite a different, I would say, time preference compared to our politicians at the moment. And when you have a look at this movie, you will see that actually there's many similarities to the current setup that we are facing. Because 40 years later, this film and especially the soundtrack by Philip Glass make an apt backdrop for today's investment environment. Koyaanisqatsi neatly captures current market conditions, which are in many ways a reaction to imbalances. Imbalances that have built for many years, if not decades, and are now suddenly erupting in various areas of life and various pockets of financial markets. Now, what do I mean by that? First of all, we're seeing obviously life out of balance in society. Worldwide, the wealthiest 10% of the population are earning about 52% of all income, and they own between 60% and 80% of all assets, depending on the region. The poorest half of the global population earns about 8% of all income and collectively owns 5% of wealth. In contrast, the richest 10% of the global population owns 76% of all wealth. Now, I don't want to sound like a social worker or a social activist, but I want to emphasize that these inequalities, these discrepancies, are a consequence of our monetary system. So the root cause for those imbalances, from my point of view, started in August 1971. Obviously, life is out of balance also in politics. We're seeing it all over the globe. We're seeing it obviously in the United States. We're seeing it in Europe. And I mean, this is a pretty big gap that we're seeing here at this table. We're seeing it in energy markets. Ladies and gentlemen, have a look at this chart. It shows energy costs in percent of GDP. 2020, 2021, 2022. Energy bills will constitute over 20% of EU household gross disposable income. This is up 8% from 2021. This is going to mean 2 trillion of additional costs. Just to compare, the GDP of the European Union is 17 trillion. So we're facing 2 trillion additional costs this year for energy. We're seeing that life is out of balance, obviously, in the currency markets. Have a look at the US dollar. Obviously, if you got the dollar right this year, you basically got everything right, you should have had a decent performance in your portfolio. Gold obviously suffered from that. And the euro, the Japanese yen, and the British pound, or also known as the British pound peso nowadays, actually were horrible, showed horrible performances this year. The Japanese yen, probably not the most unimportant currency out there, is down 25% just in 1 year. And we have seen that, well, actually time preference when it comes to politics and finance ministers isn't too strong anymore. And we had to face lots of interventions, not only in the UK, but also in Japan, where the yield curve control is basically completely destroying the Japanese yen. However, against some other currencies like the Canadian dollar and the Aussie dollar, and especially against the Brazilian real, but also against the Mexican peso, the dollar isn't that strong. So I could also say perhaps it's not the strength of the US dollar, but rather the weakness of the pound, the Japanese yen, and the euro that we're seeing. Obviously, life is out of balance in bond markets. Most people focus on equity markets, but what you see here is actually the worst performance for world government bonds since the year 1865. I don't know if anyone here remembers the big bear market in bonds, 1865, but it's been a brutal one. It's really been a brutal one. And of course, this has consequences for portfolios, especially for institutional players. The 60-40 portfolio, the holy grail of portfolio construction. Well, if you have a look at this chart, which shows the performance of the S&P 500, total return on the x-axis, and then US 10-year treasuries on the y-axis, actually, we're down here. So for a balanced portfolio, this is the worst performance since 1928. And the big difference to 2008 and 2009 is, in 2008, actually bonds had your back. They were up like 20%. In 2009, equities balanced your portfolio. But this year, both major asset classes are down big time. And I don't know if you remember the Bud Spencer movies, Bud Spencer and Terence Hill, and Bud Spencer always did like this, what we call in Vienna, the Stereowatschen. This one or this one. And this is the Stereowatschen for your portfolio actually. And gold markets are also out of balance, ladies and gentlemen. What you see on this chart is COMEX gold deliveries in millions of troy ounces. And as you can see here, basically starting in 2020, investors actually want the real stuff. They want to have physical gold and not cash settlement. Now, what is the main reason from my point of view that financial markets are that much out of balance? Obviously, it is inflation. The low inflation world basically stood on 3 pillars. Cheap immigrant labor, keeping service sector wages stagnant in the US, but also in Europe. In the US, it's been workers from Mexico, from Latin America, while in Europe, mostly Eastern Europe. I attended a conference in London previously, and I talked to an Uber driver, and he was Polish, and said, well, we were like 3 million Polish people in the UK. 1.2 million got back due to Brexit, due to COVID, but they're not there anymore. So for the workforce, this is a tremendous problem that we're seeing, and I'm not sure if the fine English gentleman really wants to work on the construction site or perhaps in a hotel or as an Uber driver. The second pillar obviously was cheap goods from China raising living standards amid stagnant wages, and the third pillar was cheap Russian gas powering the German industry and the EU more broadly. And of course, for the US, it was the fracking revolution. So these 3 disinflationary drivers, ladies and gentlemen, gave central bankers the license for years of quantitative easing and low interest rates. But now those 3 pillars of the low inflation world are changing. And central banks are now done fighting deflation with asset price inflation, and they're now fighting inflation with asset price deflation. If you have a look at this chart, it's one of my favorite ones to put it really into perspective. We've had 4 decades of falling inflation rates. So all asset managers out there, all private bankers, they've got no clue how to live, how to invest in an environment of rising and of high inflation rates. Nobody's used to that anymore because we had 4 decades of falling inflation rates. And I always say that the best questions asked about gold, I'm probably facing them in Turkey. The Turkish gold investors, they really know everything. Why? Because they're used to a rubbish currency. They're used to deal with very, very high inflation. And for them, having gold in their portfolios is just natural. It's completely normal. And I think this will come back in the Western world as well. I think inflation is not a big catastrophe, of course. It has impacts on our lives, on our portfolio constructions. But I think that people will learn to live with higher inflation rates. But actually, from my point of view, I would see inflation numbers coming down. But I'm speaking for the United States in particular now. Have a look at the break-even rates. They're basically coming down since the spring. They're always a leading indicator because this is actually what markets are pricing in. But from my point of view, over the next couple of months, just due to the base effect, just to the effect that the shelter component, the real estate component in CPI is now finally turning down, that we're comparing lower commodity prices with the prices 1 year ago. Due to those statistical features, inflation numbers will come down over the next couple of months in the United States. And this means that central bankers will basically say, we did it, we broke inflation. And this will give them more leeway to actually become less hawkish. But, and that's the bad news, we expect some inflationary waves. So if we compare it to the setup from 1966 till 1983, actually there are some similarities. So if this is like the second inflation wave peaking now, we should expect a third inflation wave. And I think that first of all, the wage price spiral, this is really the big topic going forward because people will demand significantly higher wages, and this will spill over to many other pockets of the economy. But for now, I think that inflation rates will come down over the next couple of months, particularly in the US. In the Eurozone, it's a totally different story, unfortunately. We're importing due to the weakness of the euro. Of course, we're importing more inflation. I think it's much more structural, it's much more sticky in the Eurozone. And obviously, Madame Lagarde has been asleep over the last couple of months. So while Jay Powell has obviously been much more aggressive, the ECB is way more behind the curve than the Federal Reserve. And it's also the economy that is out of balance, ladies and gentlemen. So from my point of view, over the next couple of months, markets will focus less on inflation and they will focus more on the upcoming recession. And actually, when I have troubles falling asleep, I listen to Jay Powell and it helps. And I really don't trust what central bankers keep communicating. But former Federal Reserve employees like William Dudley, they even sometimes tell us the truth. Well, Dudley said in April, if financial conditions don't tighten on their own, the Fed will have to shock markets to achieve the desired response. It will have to inflict more losses on stock and bond investors than it has so far. And he succeeded. Actually, if you have a look at this chart, global equities, bonds, property, and other asset classes have wiped out over 60 trillion in market cap. Just to compare it, this is 60% of global GDP, or more than the combined GDP of the US, China, Japan, India, France, UK, Brazil, and many other countries. Lots of capital has been destroyed. Actually, on a nominal basis, this is the biggest wealth destruction in history of mankind. Now, many people would say, well, this is actually, it's just paper money. It just evaporated. Yeah, it doesn't really have any consequences. I said that recently, that I've met a very, very wealthy gentleman, probably like a couple of 100 million, and he said, having a look at my brokerage account, it's a disaster. It's a disaster. So I canceled my membership in the golf club. I said, well, actually, that doesn't make any sense. I mean, on a relative basis, you've got a couple of 100 million and you don't spend, 15,000, whatever, on your golf club membership. I said, yes, I want to show that actually I'm doing something. So people are reacting to those measures, to those developments. We're not rational human beings. We're not as they used to tell us, the Homo economicus. We're reacting to those developments, and therefore it has real consequences on the economy. Have a look at this chart. This is showing the consumer sentiment based by the Michigan University survey. It had the weakest reading since the 1970s. So actually, US consumers are more negative than during the great financial crisis, during the dot-com bust, during the COVID crisis. Now, many people say, well, actually, the US is still doing quite okay. The US economy is quite resilient. Why is it that resilient? From my point of view, one of the primary factors is actually that US consumers are maxing it out. Have a look at US consumer loans going through the roof. There was a great interview with the CEO of Walmart. He said, well, actually, they are experiencing now that US households don't use their debit cards or cash anymore for their grocery shopping. They're using their credit cards now, big time. So I think this is one of the reasons why the US economy is still doing kind of okay. But if you have a look at this chart, which is showing the top 10 leading indicators, one of the most reliable recession indicators. It got 5 out of the last 5 recessions right. And leading indicators are showing into the future, while CPI, GDP and stuff like that basically tell you what has happened over the last couple of months. So the leading indicators went through 0, which has, as I've said, since 1980, a perfect track record of signaling recessions. And if we have a look at the ISM index, well, actually, every time the ISM drops below 50, the Federal Reserve started lowering interest rates. Well, actually, the ISM went below 50 quite recently. And this is one of the main reasons, ladies and gentlemen, why I think that actually the next moves in rates markets will probably be down and not up. Now, obviously, monetary policy is also out of balance. If you have a look at what Jay Powell, for example, said, I think we now understand better how little we understand about inflation, which is an utterly remarkable concession. The Fed has one job and 400 PhDs to help him do that. And then, Madame Lagarde, I see an inflation profile that looks like a hump. We are firmly of the view, and I'm confident, that inflation will decline in 2022. Now, I don't want to badmouth or criticize them, but the big question from my point of view is, they've got a very, very poor track record. If they would be working in financial markets, if they would be fund managers, if they would be analysts, they would be out of their jobs pretty quickly. But why do financial market participants nowadays believe what they're telling us? Why do they believe this hawkish narrative that they will continue hiking interest rates, that they will be very, very tough on inflation. I just don't see it. I think there will be reasons coming up and they will start reversing their policies pretty quickly. And if you have a look at this chart, I think it's important to remember, ladies and gentlemen, at the beginning of the year, interest rates were at 0. Now we're heading into the direction of 5%. So this has been one of the fastest and most aggressive rate hike campaigns in the history. Since 1915, 17 out of 20 rate hike cycles ended in a recession. Now we're living in the most over-levered economy ever. So the sensitivity to rising interest rates is higher than ever. So from my point of view, it is just normal. It is actually our base case that we're heading into a recessionary environment. So I don't believe that Jay Powell is really the new Paul Volcker. And the main reason for that is we actually made a very, very good comparison between the stagflation in the 70s to the current stagflation. And the main reason, obviously, is the debt levels. On a government, on a company, and on a private level, debt levels are actually between twice and 3 times as high as in the previous stagflation. So the leeway for Jay Powell to aggressively hike interest rates is much, much lower than the leeway that Paul Volcker had. And as Ludwig von Mises said, people are complaining about inflation, but they enthusiastically support policies that can only be accomplished with inflation. Well, actually, another big difference is that Paul Volcker had the full support of the White House. First Jimmy Carter and afterwards Ronald Reagan. If the US enters a recession next year, if unemployment goes up, I think Jay Powell will be the first to be blamed for that recession. So I expect major pressure on the Federal Reserve if the recession really gets going. So my take is clear. I don't buy into this narrative that central bankers have now really become hawkish. But what does it mean for gold, ladies and gentlemen? Well, actually, many people are slightly disappointed with the performance of gold. Inflation running at 8%, we've got a war in Europe. People would have expected gold to skyrocket. Well, life is all about expectations, as we know. And to be honest, I would have expected slightly more from inflation as well. But as we see here, well, it doesn't always turn out in reality as expected. So, actually, if we have a look not at the dollar gold price, but rather at the world gold price, we're trading very close to all-time highs. If we have a look at this table, just to put the performance of gold into perspective, ladies and gentlemen, actually in dollar terms, gold is down 4%. In euro terms, it's up 7%. In British pound terms, it's up 11%. So if we zoom out the enormous strength of the US dollar, actually gold has done a pretty okay job, I would say. And the sentiment is extremely negative at the moment. Have a look at this chart by Sentiment Trader. We're having basically the worst sentiment readings since 2018, fourth quarter 2018. You remember what happened then? Jay Powell did a big pivot. And the Wall Street Journal had in September, 20th of September, they had a very, very bearish article on gold on their front page. It reminded me a little bit of the FT article, which actually nailed the lows of the gold market in the previous cycle. So the sentiment on gold is already very, very pessimistic. Let's briefly talk about the mining space. Actually, the gold miners, the producers, they're just doing fine. Have a look at their all-in sustaining cash costs. Obviously, They have risen slightly. I talked to many mining companies previously at the Zurich conference, at the Precious Metal Summit, and I think people tend to forget that business owners react to developments. Of course, they react to rising prices, and they find solutions. They find alternatives. So I think that, of course, we have seen rising input prices for many of the miners, but I think they're dealing with that. But actually, if you have a look at the average gold price, the margins are still quite healthy. But on a relative basis, the mining space, so this is the HUI index versus gold, they're extremely oversold. Of course, they have been oversold actually since 2016. But on a relative basis, I think that miners are probably now a really, really good deal. Let's have a brief look at the seasonal component. Actually, November shows by far the best seasonal performance of gold. December is also quite okay. And then January and February are also positive months for the mining space. I would never act just on a seasonal basis. This is just an additional driver from my point of view. But seasonality is definitely supportive over the next couple of months in the mining space. And let's now briefly come to a conclusion. In our last In Gold We Trust report published in May, we said actually as long as they keep hiking interest rates, we should be a little bit fearful. We don't expect too much from the price of gold. We wrote, we believe it is illusory that the Federal Reserve can deprive the market of the proverbial punch bowl for any length of time, and we seriously doubt that the transformation of doves into hawks will last. But sooner or later, we'll see the consequences of monetary tightening, recession, rising yields, stock market corrections, bankruptcies, and unemployment. And then we'll really see if they're hawkish or if they turn dovish. And if we have a look at the valuation of gold now, finally, ladies and gentlemen, I think it has always have to be regarded relative to other monetary aggregates. For example, versus the monetary base versus M3, also versus federal debt, versus the S&P 500 versus the US dollar. You can tell that actually compared to previous peaks, 1980 and 2011, gold is dirt cheap at the moment. Now I'm coming to my conclusion already. Ladies and gentlemen, the decades of disinflation, they're over. The great moderation has ended. We have seen an inflation shock, afterwards a rates shock, and the next shock will be the recession shock, and there will be a pivot. But politicians will shield the private sector and they will try to offset all losses using the government balance sheet. This is actually one of the key lessons from the COVID crisis. Our politicians really enjoy their power. They enjoy taking care of all aspects of our lives and subsidizing not only private households but also industries. But there will have to be a release valve. It's either going to be the currency or bonds. The current wave of inflation is about to peak soon, especially in the United States, but inflation will continue in waves. And the crucial question, ladies and gentlemen, is when will monetary tightening stop? And from my point of view, the next FOMC meeting, I think it's 14th of December, this might be the last rate hike in this cycle. Now, actually, there wasn't only one movie, Koyaanisqatsi, there was a second one, which is a horrible movie. Don't watch it. It's called Koyaanisqatsi. And basically, if we want to return to balance, we have to rebalance. We have to rethink and we have to renew. And ladies and gentlemen, from my point of view, sooner or later, the international monetary order will be reorganized over the next couple of years probably. And I think that gold will play a central and major role in this reorganization of the monetary order. Thank you very much for your interest. I hope you enjoyed it. Thank you.
Thanks a lot.